Wall Street is bracing for an IPO projected to hit a $1 trillion valuation, fueled by explosive revenue forecasts from artificial intelligence leaders. This valuation relies on a core flaw in investor logic. The market is pricing OpenAI like a traditional software company, assuming that each new customer can be served at a near-zero marginal cost. Generative AI operates as heavy industry. Every prompt triggers hardware to spin up, mirroring a manufacturing plant. The financial consequence: revisions suggest losses reaching $25 billion by 2026, with cumulative cash burn hitting $665 billion by the decade's end. OpenAI intends to use the $60 billion from this IPO as an emergency life support system. This capital is required simply to keep the servers running and provide the company with an 18 to 24-month window of breathing room. The unsustainable physics of this business model turn the impending IPO into a financial time bomb. The massive capital demands risk triggering widespread chaos across Wall Street. Large institutional investors stay fully invested to hedge against inflation, which leaves them with very little idle cash to cover a $100 billion buy-in. To participate in the IPO, these giant funds must liquidate their most reliable holdings. They begin dumping massive blocks of highly liquid stocks like Apple, Amazon, and Tesla to free up the necessary capital. This diagram tracks the immediate market chain reaction. As heavy selling hits the tape, prices begin to slide. Automated trading algorithms detect the drop and immediately trigger short positions to protect themselves, accelerating the decline. This algorithmic pressure creates a vicious cycle. Lower prices execute the stop-loss orders of regular retail investors, causing a wave of forced selling that wipes out the value of solid, profitable companies across the index. The sheer gravity of OpenAI's funding needs extracts value directly from the proven winners that anchor most 401k plans and pensions. The market's liquidity is siphoned away before the new shares even begin to trade. A common counterargument suggests that tech giants like Microsoft and Nvidia have balance sheets strong enough to absorb this shock or act as a backstop for OpenAI. This diagram shows why that safety net is an illusion. Microsoft has locked in a closed loop where their investment flows to OpenAI and then circles immediately back to Microsoft as rent for Azure cloud servers. Nvidia faces an identical vulnerability. Their projection of $1 trillion in data center revenue depends entirely on a small group of frontier labs continuing to place massive orders for specialized chips. If the high cash burn forces OpenAI to slash its serving usage, this loop snaps. Billions in expected revenue for both Microsoft and Nvidia would evaporate instantly, turning a major cloud customer into a massive liability. Big tech cannot provide a safety net because they are chained to the same sinking anchor. If OpenAI's spending contracts, the entire sector faces a shared collapse. OpenAI has spent years hiding its catastrophic losses behind private venture capital and non-disclosure agreements. Filing for an IPO subjects the company to the strict legal transparency of the SEC for the first time. Federal accounting rules require that specialized AI chips be treated as depreciating industrial assets. Since these architectures become obsolete every 24 to 36 months, the public filings will be forced to show billions in hardware write-downs each quarter. The audit will also expose the physical bottlenecks that prevent rapid scaling. This includes a multi-year wait for step-down transformers and the massive high-voltage grid upgrades required to power frontier data centers. These documents will prove a structural paradox. Every new user multiplies the financial burn. Because AI is a resource-heavy utility, revenue growth cannot mathematically outrun the rising cost of infrastructure. As Wall Street digests these filings, investors will be forced to reevaluate the entire $1.6 trillion private AI startup market. The realization that the sector's unit economics are broken triggers a massive, aggressive sell-off across the board. The damage spreads to credit markets as corporate bond spreads widen. Companies that borrowed heavily to chase the AI miracle are suddenly viewed as severe risks, causing trillions in paper wealth to evaporate as the $1.6 trillion private valuation bubble implodes. The catastrophic market correction of the 2020s happens because the SEC finally forced transparency on a sector that attempted to outrun the laws of physics and industrial accounting. The math simply caught up with the hype.